Hi guys, welcome and thank you everybody for joining today's session. Today's session is end of year tax planning for founders and investors. For those of you that don't know, my name is Samuel Ajala, and over the next 45 minutes, we're going to walk through the key strategies you can still use before the 5th of April 2025 to reduce your tax bill. Not just reduce your tax bill, to organize your finances and also to prepare for the year ahead, which is 25-26. So, here is what we're going to cover: why your year end tax planning matters, personal tax strategies, founders and business tax moves, investor specific tactics, property tax planning, and planning for 2025. I'm also going to take some live Q&As as well. So please, if you have some questions, we'll send you a link before the end that you can actually, in fact, you could just write it in the comments. Yeah. So let's dive in. So why tax year end matters? Um, as many of you know, the allowances reset from the 5th of April. We certainly don't want you to miss any opportunities. You know, there's changes as well in capital gains tax as well, national insurance contributions, which is coming. Um, April the 5th is the end of the tax year. And at that point, many valuable allowances begin to reset. This includes your capital gains tax, exemptions, which is the amount of profits you can make on selling investments or property without paying any taxes. For example, if you sell shares and make £10,000 profit, you'll pay capital gains tax only on the amount above the exemption. So this year is actually £10,000 minus 6,000, which is 4,000, which is taxable, right? So that capital gain tax free threshold, so to say, is actually £6,000. And that's the amount that you would have available for you for this year. Also, your ISA allowance. Your ISAs are individual savings accounts that let you save or invest up to £20,000 each year, which is tax free. So an example of this is that if you invested £20,000 in stocks and shares ISAs, and it grows to about £28,000, you won't pay any tax on that 8,000. No income tax, no capital gain tax, completely and utterly free. So again, this is one of the things that we need to take advantage of. And also your dividend allowance. This is how much you can earn in dividends before paying tax on them. And so we're going to be looking at all of this in this session today. As I said, please make comments, ask questions or comments, and we're going to try to deal with it at the end. I'm looking at two screens here at the moment. So this particular screen, I'm doing a live, and then we're doing a presentation as well here as well. Okay, so let's dive in. We're going to first look at personal taxes and the strategies that you can apply for personal taxes. So first things first, you can use your remaining £1,000 dividend allowance. That simply means, just bear with me, that simply means that any dividends above that are taxed. So if you've got a company paying dividends, now the time is to act. Next, there's your capital gains tax exemption, which is £6,000. You know, we mentioned that before, but it's being cut to £3,000 next year, right? So from 25 to 26. So now you want to try to take advantage in this year before the year end closes out, which closes out next week, right? Next week, Saturday. So if you're planning to sell any investments, consider doing it before the 5th of April to use the higher allowance. Also, you need to make the most of your ISA. if you could pull up to £20,000 into one each year, and the returns, whether interest, dividends, or capital gains, are completely tax free. So, for example, if you have some spare cash to invest before the end of the year, topping up your ISA can actually shield those returns from tax indefinitely. Yeah. Um, and also, don't forget about pensions. Contributions to pensions come with tax relief, meaning that if you are a higher rate taxpayer, you effectively get 40% back from the government. Um, we're going to look at it in the company, but remember your company can also invest on your behalf as well. So make sure that you actually consider that as well. Yeah. Let's talk about the SEIS and the EIS. And these are government schemes designed to encourage investments in early stage startups. And the EIS stands for Seed Enterprise Investment Scheme, and the EIS stands for Enterprise Investment Scheme. Both offer generous tax reliefs. With the SEIS, you can claim back up to 50% of your investments against your income tax bill. And with the EIS, is up to 30%. You can also defer capital gains or claim loss relief if the company doesn't succeed. So, for example, let's say you invest £10,000 in a startup through SEIS, you could claim back £5,000 in tax relief. And if the company fails, you might recover up to 86.5 of your investment through loss relief, right? So it's almost like a win-win situation. Better still, you can still carry back those investments to last year's income, reducing a previous tax bill if you haven't used the allowance yet, right? Up next, we're going to now look at tax strategies for founders and business owners. Um, in fact, we have a lot of our clients and audience and the people that listen to our content actually fall into this category as well. Who are a lot of them are actually business owners. So we're going to look at strategies for founders and business owners. So if you're a company director, think about your salary versus dividends. Paying yourself a small salary and topping up with dividends is often more tax efficient than taking a full salary. For example, if you pay yourself a salary of £12,570 and take the rest as dividends up to the basic rate limit, you could significantly reduce your tax bill versus taking it all out as a salary. Consider whether you can bring forward any business expenses before the year ends. Things like professional fees, software costs, or equipment. This can reduce your taxable profits. If you spent money on developing new products or technologies, you may also qualify for R&D tax credits. These are government incentives that give you a cash rebate or tax reduction on qualifying innovation spend, right? And in our accounting practice, we actually have a particular department that deals with this. So if you fall into that category, please ensure that you reach out to us. One of the things that we're actually offering after this session is a tax plan, a completed tax plan. We'll look into your situation, we'll look into your investment portfolio, your business, and we try to produce a complete tax plan for you for the year 25-26 to ensure that you are absolutely and 100% tax efficient in that tax period, right? So I'll give you an example now of tax, R&D tax. If you spend 50,000 on qualifying R&D, like software development, you could claim back up to 33%. That's £16,500, either as tax saving or cashback if you're loss making. And if you're looking to raise money or sell your business soon, get your financials in order now. Investors will want to see clean, well prepared numbers. Yeah. So now we're going to move on to investor specific tactics, right? Especially those backing startups or building portfolios. Now, if you're already invested in EIS or SEIS qualifying companies, you might be able to carry back those relief to last year's income and reduce your previous tax bill. You can also offset gains from one investment with losses from another, helping to reduce or eliminate your capital gains tax. So an example of this is if you've made £10,000 on one investment and 7,000 loss on another, you can offset them and only pay capital gains on the £3,000 gain. If you're investing through ISAs or pensions, remember, these are wrappers that protect your investment from tax. If you're not using them, you're likely overpaying. And if you're married or in a civil partnership, you may be able to gift assets to your partner to make use of both of your tax allowances. For example, if your spouse is a lower tax bracket, so for those of us that don't know, lower tax brackets, more or less under 50k or so. If your spouse is under that, you could actually gift them shares or properties before selling. That way, more of the gain is taxed at a lower rate, and not all of it is taxed at a higher rate. So I think that this is something that could certainly benefit you if you plan in due course. Yeah. Now, this is another topic that many of us are very interested in, and this particular topic is properties. We have a lot of people here into properties. We have loads of inquiries into properties as well. So let's touch on properties now. If you're planning to sell a property or you're completing the sale before the 5th of April, it could help you to use this year's higher capital gains tax allowance. For example, if you're selling a buy-to-let property with £200,000, with £20,000 gain, selling before April the 5th lets you use the £6,000 capital gains tax exemption. Wait until the 6th and you only get £3,000 exemption. So again, this is something that you really could take advantage of. Also, we have section 24, which is another important rule. If you own a property personally and have a mortgage, you can no longer deduct all of your interest costs before calculating the tax. This rule doesn't apply in the same way to company-owned properties, which is why many landlords are shifting properties into limited companies. Also, be aware that stamp duty land tax, which applies to property purchases, the thresholds are changing in April. So if you're buying or transferring property, check whether it's better to complete before or after the new tax year, right? And finally, we're going to look at how to prepare for tax in 2025. So basically, tax preparation. That goes without saying, it's quite important to keep your records clean and up to date. It makes planning and compliance a lot easier, which again, if any of you do require tax planning, we have a number of consultants there that are prepared to work with you and help you plan for the year 2025. I have to say, it does surprise me the number of people that leave quite a lot of money on the table. And this can be easily avoided if you actually know what you're doing. So please reach out to us if any of these are actually relatable to you. So know your thresholds. For example, the capital gains tax exemption is dropping, employers' national insurance is increasing, and dividends allowances are shrinking. So your 2025 plan should account for these. And above all, don't treat tax planning as a last minute rush. With the right support, tax can be a tool to grow and to protect wealth. If you have any questions now, guys, I'm going to ask you to send in your questions. I'm going to try to answer some of your questions. So drop your questions in the comments now. And thank you again for being here. You'll receive a follow-up email with a replay and a downloadable link for yourself as well for you to review. And if you like, I would put a link in the email if you need to have a 15-minute chat consultation, and then we'll see what we can possibly help you to do. Yeah? Fantastic. So we have a few questions here. Let's go through some of the questions now. Can I still top up my ISA before the tax year ends? The answer is yes. You can actually contribute up to £20,000 in your ISA before the 5th of April. So if you've only contributed, let's say 15,000, you have scope to actually take full advantage and to maximize the amounts that you have, right? So any interest, dividends or capital gains earned in ISAs, remember, are completely free. What happens to my capital gains tax allowance if I don't use it this year? It disappears. Completely disappears. The current allowance is £6,000, but it drops to £3,000 between the 5th and the 6th. So the 5th is the last day you can take advantage of that £6,000 allowance, and I believe that's next Saturday the 5th, and then by Sunday it automatically kicks in. So you actually have just over a week now to take advantage of that. What else do we have here? Are pensions still worth contributing to at year end? I'll say absolutely. Pensions reduce your taxable income, and higher rate taxpayers can get up to 40% tax relief. You can also carry forward unused allowances from your past 3 years. So again, I would say that this is certainly something that you could do. I would recommend it. What's the deadline for making a pension contribution? As I said before, April the 5th, make sure your contribution, make sure contributions clear your account before the 5th for it to be valid for the 24-25 tax year. Yeah. What's the difference between SEIS and EIS? Well, good question. The SEIS is for very early stage startups, and it offers up to 50% income tax relief, right? So it's usually for investments up to 200,000 worth of investments. Now the EIS applies to more established startups and offers 30% relief, and it's usually about up to 1 million or 2 million for knowledge intensive businesses. Yeah. Should I take more salary or dividends before year end? Well, that will depend on your income mix. Many directors use a low salary, maybe up to £12,570, and dividends up to the basic tax limit to minimize tax. Over £1,000 in dividends, you start paying tax at 8.75 or more. Right? I hope that makes sense. Yeah. Can I expense software subscriptions? Let me read this question. Can I expense software subscriptions or professional fees before April the 5th? Yes. Yes, you can. I'm just trying to understand what you mean. You could bring forward expenses like software training or even accounting fees can reduce your taxable profits this year as well. How do I know if I qualify for R&D tax? If your company is developing new products, systems, or technology with some element of uncertainty, it likely qualifies. You can claim up to 33% of eligibility cost as a tax credit. Again, get in contact with we have some really, really brilliant consultants who are part of our firm that can assist you with that. Uh, what if I am planning to raise funding soon? How should I prepare now? Get your financials clean and investor ready, if I'm honest with you. Make sure you're using cloud accounting, forecast cash flows, and separate business versus personal expense, right? So we just need to make sure the company books are absolutely clean and ready for investors to want to invest in. Can I carry forward business losses to next year? Yes. Trading losses can often be carried forward to offset future profits or carried back to offset past profits and to claim back tax as well. What do we have here? Can I use EIS to reduce last year's tax bill? Yes. You can carry back SEIS or EIS relief to the previous tax year, reducing tax bill you've already paid or are about to pay. Uh, Another question here. Can I claim loss relief on failed investments? Yes. If you've invested in EIS or SEIS and the company fails, you can claim back losses against your income tax or SGT, reducing your risk significantly. Yeah. Can I offset gains from crypto or shares with other losses? Yes. Capital losses from one asset can offset capital gains from another in the same tax year or carry forward. Excellent. Are ISAs still worth using if I'm already investing in EIS? Good question. Yes, they serve different purposes. An ISA gives you tax-free growth, while an EIS gives you upfront tax relief. They work great together, by the way. Again, get in contact with us. This is something we can assist you with. What happens if I gift shares to my spouse? Do we still pay tax? Gift between spouses are exempt from capital gains tax. So this can help you both. This can help both partners allowances and lower your tax bill as well. All right. So the person that asked that question, I hope that helps. Sorry, I forgot that we're actually on live Q&A now. Uh, we only have a few minutes left, actually. Um, okay, what do we have here? Property tax. Should I complete a property sale before the 5th of April? If you want to use the full £6,000 capital gains exemption before it drops, yes. But timing also depends on other incomes and goals. Yeah. Guys, let me just take a few more, if that's okay. Uh, what is Section 24 and how does it affect me? Well, good question. As somebody that's in property myself, um, Section 24 basically restricts how much mortgage interest landlords can deduct from rental income. Instead, you get a 20% tax credit. This increases your tax income. Yeah. Um, is it better to hold a property personally or in a limited company? It depends, really. Um, Companies benefit from full mortgage interest relief and lower tax on profits, but you may face double taxation when taking money out. All right, so that's something to consider. Again, get in contact with us and we'll be able to assist you with that. What's happened to stamp duty in April? Well, stamp duty threshold reverts to holiday level, meaning many buyers will pay more in stamp duties from April 2025 onwards. Yeah. And what should I do first if I haven't done any tax planning yet? Start by reviewing your personal and business income. Look at what allowances you haven't used. So we're talking about ISAs, capital gains tax, pensions. And if you're unsure, please feel free to book a call with us, and we'll be certainly willing to assist you before the 5th of April. So again, guys, just want to take the opportunity to thank you for taking the time out today. I really hope today's meeting has helped. In the email we send you, we're going to send a link as well for the 50-minute consultation. Just feel free to get in contact with us, and we'll assist you and help you as much as we can. Once again, guys, I want to thank you for taking the time out to listen to this. Again, the live recording will be shared to all of us, the link to our emails, please, for you to rewatch again. And then I also put a link in there for you guys to book a call with myself or with one of my team. Right? Once again, guys, really want to appreciate you. Take care and enjoy the rest of your day.